All right, let's unpack this. We have a stack of sources today that paints, well, a really fascinating picture of economic tension. You've got this dizzying high-speed future of AI on one side,
Hmm.
and then the gritty reality of physical infrastructure, consumer strain on the other.
It truly is a perfect moment to analyze the market, isn't it?
Mm.
You see capital just rushing toward this, you know, technological singularity idea,
Right.
while the existing plumbing, the power grid, the labor market, it's all visibly straining just to keep pace.
So our mission today is to give you the shortcut. Where is all that capital flowing right now? And what are the key signals telling us about the near future? We're going
Yeah.
to try and distill these massive investment bets in AI, trace the kind of unexpected costs those bets are generating.
Right. The hidden costs.
Exactly.
Yeah.
And then check the pulse of the global consumer and, the central banks trying to manage it all.
And today's deep dive is going to take us from Boston venture capital rounds all the way to surging capacity prices on the eastern seaboard power grid. Well, before we even get into why consumers seem to be hitting the brakes on high-interest debt, we'll look at a startup moving beyond what they call vibe coding.
Okay.
Trace these massive multi-billion-dollar infrastructure commitments by players like Anthropic, and then, yeah, look at the rising political backlash over electricity prices in some major states.
Okay, let's start there with the AI investment frenzy. A great example, I think, of where VC money is moving is this Boston-based startup, Code Metal. They just raised 36.5 million. Excel led the round.
Right. NSL, they have a track record, Facebook, Dropbox early on. This raise is significant because of Code Metal's approach.
How so?
Their technology lets engineers write code once, basically, and then it automatically translates it into other programming languages,
Ah, okay, so speeding things up.
drastically speeding up feature deployment, yeah,
Hmm.
especially across diverse systems.
And their CEO, Peter Morales, he really drew a line in the sand, didn't he? He positioned the company as distinct from vibe coding platforms.
He did. That's the term he used. He's talking about the tools, like, maybe Anthropic's Claude Code, that generate initial code from text prompts.
Okay, so what's the real difference then?
That distinction is, well, it's everything for them. Vibe coding might help you get a first draft, maybe an
All
MVP,
right, a starting point.
but Code Metal is focused on getting code to production, and that demands strong guarantees, real accuracy and compliance.
Strong guarantees. How do they achieve that if it's not just like an LLM?
They use something called formal methods. It's a computer science technique to rigorously check the converted code, something that, large language models alone just can't promise right now.
Formal methods. Okay. But looking at their customer list, U.S. Air Force, Raytheon, L3 Harris, auto suppliers, it seems heavily weighted towards defense and manufacturing.
It is.
Is this mainly a technological advantage, or is it maybe just a smart strategy to corner a, let's say, smaller, more reliable niche away from the crowded consumer-facing tools?
I think it's probably both, which is why Excel is likely interested. Their partner, Steve Laughlin, he called the market opportunity practically uncapped.
Uncapped. Really?
Yeah, especially for modernizing legacy code bases, which is a huge headache, and for development on the edge, outside data centers. This need for reliable, high-assurance tech. Well, that ties right into the next huge infrastructure bit we're seeing.
Speaking of huge bets, this hyperscaler arms race, it's getting kind of surreal. Anthropic just announced plans to spend, what, $50 billion?
$50 billion, yeah,
Huh.
on US AI infrastructure, starting with data centers in Texas and New York. First sites apparently going live in 2026.
That's a massive number, 50 billion. But then you hear reports about Ravel OpenAI pushing for commitments potentially reaching 1.4 trillion long term.
Right, it makes 50 billion sound almost restrained.
Exactly. So does this signal Anthropic is being more realistic, taking a phased approach? Or are they just playing a completely different, maybe smaller game?
That's the big question, isn't it? Realism or maybe hedging their bets? Either way, the underlying confidence from the tech sector is palpable.
Yeah, like AMD's CEO, Lisa Su, she recently just dismissed fears about all this spending, called investment in AI and computing the right gamble.
And she's projecting AMD revenues will grow 35% per year for the next 3 to 5 years, driven by what she called insatiable AI chip demand.
Insatiable. That's a strong word.
And it's not just projections. We're seeing it in actual cash flow. Look at Cisco's recent earnings, Q1 2026. Their networking business grew 15%.
Okay.
But the key detail was the acceleration in AI infrastructure orders. They booked $1.3 billion just from hyperscaler customers.
Wow, 1.3 billion just from them just recently.
That's enterprise money hitting the books right now. It's real.
That is a staggering amount of current spending. Okay, so let's connect the dots here. You have all this capital throwing into AI chips, data centers.
Seemingly unlimited capital, yeah.
But what about the immediate visible physical costs? Because this boom, it isn't free for everyone, right?
Absolutely not. And we are seeing significant political backlash starting to brew, particularly in the mid-Atlantic states.
Why there specifically?
Over surging residential electricity prices. We're talking 21% hikes proposed or happening in New Jersey, 13% in Virginia. And data centers are right there in the crosshairs as a major cause.
Okay, wait. Why such a massive jump in electricity costs? What's the direct link?
Well, look at the PJM interconnection grid. That's the one serving those regions, New Jersey, Virginia, others.
Right.
Their capacity prices, that's basically what utilities pay to guarantee power, is available for peak demand.
Okay, I got it.
Those prices skyrocketed, over 500% between late 2022 and 2024. Went from about $2.2 billion to almost $15 billion, $14.7 billion.
500%. That's an absurd rate of increase. Was there an official reason given?
Yes, the independent market monitor who reviews PJM, they identified large load additions from data centers as the main culprit. Plain and simple.
So the utilities just can't plan or build fast enough for this demand?
Seems like it. The CEO of PPL, one of the utilities, confirmed this. He said the demand is so fast and furious, they need to start building new generation immediately.
Wow.
And just to give you a sense of scale, in Pennsylvania alone, planned data center capacity jumped over 40% recently. It's now at 20.5 gigawatts.
20.5 gigawatts. How much is that in real terms?
That's roughly enough power for about 17 million average U.S. homes.
Just for data centers planned in Pennsylvania. Yeah. Incredible.
Yeah. And inevitably, that leads straight into political friction.
Right. We're seeing reports, Democrats accusing the Trump administration of failing to protect consumers who are now essentially forced to subsidize the cost of data centers.
While the industry, the Data Center Coalition, pushes back, insisting they're committed to paying its full cost of service.
So it really raises that fundamental question. If this kind of innovation requires immediate, massive infrastructure build-out, who ends up absorbing that initial shock to the system? The consumers. The company.
That's the debate right now. Okay, so shifting focus a bit from that infrastructure strain, let's look at the broader macroeconomic signals. How is the consumer actually holding up under this kind of high-cost environment?
Well, there are some subtle shifts happening at the Federal Reserve. Atlanta Fed President Raphael Bostic, he's known as kind of a centrist, cautious on rate cuts this year.
Right.
He announced he'll step down when his term expires in February 2026.
Interesting timing. And the general mood among the current leadership, it still seems pretty cautious, right? Boston Fed President Collins, she supports holding rates steady for some time, sees a high bar for more cuts, even after that quarter-point cut back in October.
Yeah, seems like patience is the word.
Yeah.
And we should probably note, the Supreme Court is set to hear arguments soon, January 21st, regarding President Trump's bid to fire Fed Governor Lisa Cook over some allegations predating her service. Just another political factor swirling around.
True. But setting aside personnel changes for a moment, if you look at the average person's balance sheet, it suggests some significant strain. Overall consumer credit growth is definitely slowing down. Auto loans, for instance, showed a year-over-year increase of only 0.30% through Q3 2025.
0.3%, that's tiny.
It's one of the slowest growth rates we've seen since, like, 2010. Really flat.
And what about credit cards? People usually lean on those when things get tight.
Well, even there, revolving credit growth is slowing down noticeably. It's up only 2.55% year over year.
Okay, 2.55%. But isn't the average interest rate on cards still really high?
Exactly. The average rate is sitting at an elevated 21.39%.
21%. Wow. So when you see credit growth slowing, even with rates that high, doesn't that scream caution? Like consumers are prioritizing just staying afloat, not taking on more discretionary spending.
I think it absolutely suggests an unwillingness or maybe inability to take on more of that high-interest debt. It's a pretty significant indicator of underlying stress, something the Fed is certainly watching very closely.
And this strain, it's not just a U.S. thing, is it? We saw some data from the U.K. too.
Yeah, across the pond, weakening U.K. labor market data just came out. It definitely strengthened the case for rate cuts over there.
What did it show?
U.K. unemployment. It unexpectedly rose to 5% for the 3 months leading up to September, and the number of payrolled workers actually fell by 32,000.
So some slack appearing in the labor market.
Exactly. And that immediately impacted market thinking. Financial markets are now pricing in about a 75% chance of a Bank of England rate cut in December.
Because weaker pay momentum is what central banks want to see before cutting, right? To feel better about inflation.
Precisely. They need confidence that wage pressures are easing before they feel comfortable easing policy.
Okay, so we've got cautious central banks, seemingly stressed consumers. How are smart companies adapting their strategies to these realities? Let's wrap up maybe with a look at some strategic shifts in retail and mobility.
Yeah, there's a clear playbook emerging, especially at the premium end. Take Skims, Kim Kardashian's brand.
Right, just got valued at $5 billion. dollars.
$5 billion, yeah, after a new $225 million funding round led by Goldman Sachs. Now, they built their brand almost entirely online, digital first.
Hmm.
But now they're pivoting. They want to become a predominantly physical business, using that new capital for brick-and-mortar stores and international expansion.
Interesting. Moving from digital hype to physical presence. Why now?
Seems they feel they need that tangible, reliable presence to really scale up to the next level, to build lasting value beyond just online buzz. It feels more durable.
And we're seeing a similar flight to quality elsewhere, right? Like with the Swiss sneaker brand On.
Absolutely. On
Yeah.
just raised their guidance for the third quarter in a row. Pretty impressive.
Yeah.
And their CEO stated very explicitly
Yeah.
they will be full price through the holiday season. That includes no Black Friday discount.
No discount at all. That's bold.
It is. It's part of their stated strategy to be the most premium sportswear brand. They're signaling they don't need discounts to move product.
So they're deliberately positioning themselves away from that price-sensitive, stressed consumer we were just talking about.
Exactly. They're betting on the resilience of the premium market. Now, shifting over to mobility, Alphabet's Waymo hit a really critical milestone.
The robo-taxis?
Yeah. They launched paid freeway robotaxi rides in San Francisco, LA, and Phoenix, driving up to 65 miles per hour.
Paid rides on the freeway. That's a huge step up from just, low-speed city blocks.
It's major. Moving on to high-speed commercial routes. Plus, they expanded service to San Jose International Airport. It signals real confidence in their driverless tech at scale, and it opens up totally new revenue streams.
Okay. And what about traditional auto? Any interesting moves there?
Well, Toyota made a couple of big announcements. They started production at their new nearly $14 billion battery plant in North Carolina.
13.9 billion, yeah. Big battery investment.
Huge. And they confirmed plans to invest another $10 billion more than previously expected over the next 5 years in the U.S.
More investment. But isn't Toyota still kind of big on hybrids, even with this battery push? Especially with the EV market looking a bit sour lately.
That's exactly what's notable. While they're making this massive battery investment, they are still clearly favoring hybrids in their production planning. It looks like a strategic hedge. They're playing the long game, diversifying their bets, rather than going all in on pure EVs right now.
Okay, so pulling all these threads together, what does this all mean for you, the listener? We've kind of outlined these two parallel realities, haven't we?
Yeah, it seems like it. On one hand, you've got this seemingly unbounded, multi-billion, even trillion-dollar investment pouring into the AI future, the software, the chips.
Right, the sort of digital singularity track.
Exactly. But on the other hand, you have these very visible, very physical limits showing up. Limits in energy supply, limits in regulatory patience, limits in the consumer's ability to just keep handling more debt.
So what's the key takeaway here?
I think the biggest competitive edge right now, whether you're talking about coding platforms or sneakers, seems to be moving beyond that initial flash, beyond the vibe coding or the fast fashion trend,
Towards something more durable.
towards durable, reliable, and often premium output. Code Metal gets valued because it offers production guarantees. Crowing gets valued because it refuses to discount. And Anthropic is spending $50 billion just to ensure its own existence at the massive scale required.
It really sounds like a durability dividend is driving where the capital is flowing.
It really does. Which kind of leads us with this final provocative thought for you to mull over.
Okay.
If these enormous multi-trillion-dollar bets on AI infrastructure, the Anthropics, the OpenAIs, if they do continue to drive up electricity capacity prices and household energy bills across the country, like we've seen starting to happen in that PJM region,
Right.
does the political backlash against data centers, against those rising costs, does that eventually become the main bottleneck, the primary non-technological barrier to AI innovation, at least here in the United States?